Bitcoin just dropped 52% from its all-time high. The Fear and Greed Index hit 9. That's a number we haven't seen since the FTX collapse that took billions of dollars. And a lot of people's faith in this entire space with it. Every mainstream headline is saying the same thing right now. Bitcoin is broken. The institutional dream is dead. The cycle is over. But here's what none of those headlines are telling you. There's an argument circulating right now from one of the most respected macro minds in all of crypto that hopefully someday I can bring on this channel that says Bitcoin isn't crashing despite the macro environment. It's crashing because of it. And that the same force that crashed it is the exact same force that sends it to a new all-time high. So I'm going to walk you through that argument completely today. And then I'm going to add a new layer, my own layer, because I haven't seen anyone else connect a political layer that makes me more convinced than I've been in a long time that the money printer is coming. So let's get into it. Okay, first, let me show you the weird thing happening in the market right now. For the past few years, Bitcoin has basically tracked the NASDAQ like a shadow. Tech stocks go up, Bitcoin goes up. Risk off hits, and both fall together. The correlation got so tight, in fact, that by January of this year, it hit 0.80, meaning 80% of Bitcoin's moves could be explained just by looking at what tech stocks were doing. That made sense. Both are risk on assets. Both attract speculative capital. But here's what's happening right now that breaks that pattern entirely. The NASDAQ, relatively flat. Tech stocks have held up, but Bitcoin, down 52% from its October high, from $126,000 to around $67,000. Those two things should not be happening simultaneously. If this was just a generic risk-off sell-off, fear spreading, people dumping everything, you'd see both fall together. That's the playbook. That's what usually happens. So the divergence is the signal. And Arthur Hayes, co-founder of BitMEX, one of the most macro sophisticated thinkers in all of crypto, published an essay this week arguing that Bitcoin is behaving exactly the way it should right now. Not as a broken asset, but as what he calls the global fiat liquidity fire alarm. His argument, Bitcoin isn't falling because of crypto-specific problems. It's falling because it is the most sensitive instrument on Earth to changes in the fiat credit supply. And right now, it is detecting something that equity markets have not priced in yet. So what is it detecting? Here's the thesis I want to build for you today. AI is eliminating white-collar jobs, not as a future warning, but as a current event that's happening now. In January of this year alone, for instance, one single month, American employers announced more than 108,000 job cuts, the worst start to a year since the 2009 recession, which is up 118% year over year. And Amazon cuts 16,000 corporate jobs in a month. Salesforce shed 4,000 customer support workers after AI absorbed roughly half of their workload. And the CEOs are no longer being dramatic about it. Microsoft's AI CEO said most white-collar work will be fully automated within 12 to 18 months. And Dario Amodei, the CEO of Anthropic, one of my favorite AI model companies, warned that AI could eliminate half, listen to that, half of all entry-level white-collar jobs and spike, in turn, unemployment to 10 to 20%. He called it a potential white-collar bloodbath. Now, here's why that specific framing matters for Bitcoin. The people most at risk aren't at the bottom of the income ladder. Those jobs, cashiers, warehouse, data entry, were already automated in the last wave. The people at risk this time are in the middle, the $70,000 to $120,000 a year earner, the management analyst, the junior attorney, the mid-level software engineer, the college-educated professional with a mortgage, a car payment, and a credit card balance. Arthur Hayes says he ran the numbers on this. There are 72 million knowledge workers in the US, and banks hold $3.76 trillion in consumer credit extended to this class of people. these types of professionals. So if 20% of them lose their income to AI and can no longer service their debt, which is what would happen, his model projects $330 billion in consumer credit losses and $227 billion in mortgage losses. That's roughly $557 billion in defaults. Now compare that against total US commercial bank equity, the system's cushion, which sits around $2 to $2.5 trillion. You're looking at approximately a 13% write down of the entire banking system's protective buffer. Here's the analogy that made this click for me. Think of bank equity like the down payment on a house. You buy a $500,000 house with a $50,000 down payment, right? That $50,000 is your cushion. If the house loses $50,000 in value, your equity is gone, but you're not bankrupt yet. You're exposed, though, and the next shock pushes you underwater. So a 13% average write down doesn't collapse JP Morgan. They have thick capital buffers. But regional banks, which are already thinner on capital, more concentrated in consumer lending, are a different story. And after SVB or Silicon Valley Bank collapsed in 48 hours in 2023 because people could drain deposits on their phones at midnight, we know exactly how fast these things can move and get out of control in the digital age. And Bitcoin, which trades 24 hours a day, settles instantly, needs no phone calls to a broker, is the first thing institutions sell when they need cash fast. That's why it's leading equities down. It's not broken, it's the smoke detector. It's telling you the fire hasn't arrived yet. So that's another way we can view Bitcoin and Bitcoin's price right now. And here's the confirmation signal that I find really compelling. Gold is up 24% since October, and Bitcoin is down 50% over the same period. Two assets that people constantly compare. Two assets with limited supply, the one way more scarcer than the other. Two assets marketed as inflation hedges and stores of value, completely decoupled right now. In a normal risk-off environment, both fall, people sell everything and raise cash, but that's not what's happening right now. Gold is being actively bought while Bitcoin is being sold. So what does that tell you? It tells you investors are making a specific macro bet, a bet that a deflationary credit crunch is coming, not inflation, but deflation, a freeze, a credit contraction. Gold is the classic central bank hedge for that scenario. It's been a reserve asset for 5,000 years, and it doesn't require network effects or adoption curves. Bitcoin, in contrast, gets sold in deflationary environments because leveraged positions get margin called. Fear spikes, liquidity dries up, and Bitcoin, because it's the most liquid asset available at 3 a.m. on a Sunday, gets sold first. The gold Bitcoin divergence isn't Bitcoin losing, it's Bitcoin pricing in the deflationary shock before it hits. And when the policy response comes, when the money printer turns on, because it will, history shows Bitcoin leads the recovery too. It bottoms before the fire department arrives, which brings me to the layer I want to add, the layer I think nobody is connecting clearly enough. Hayes identifies the crisis mechanism. He concludes the Fed will eventually respond, and I agree, which is why I'm bringing this to you. But he frames it as a matter of when policymakers get scared enough, like it's an open question. So I want to make a stronger argument. Given the political calendar, the money printer isn't just likely, it's structurally inevitable, is the way I see it. And here's the context. November 2026 this year is a midterm election. Every single seat in the House of Representatives is up for grabs. Republicans currently hold a 219 to 213 majority. That is a 3-seat margin, the most razor-thin majority you can hold while still controlling a chamber. Now look at where public opinion stands. Only 23% of Americans think the economy is getting better right now. 53% think it's getting worse. Only 1/3 believe their family's finances will improve this year. Democrats now lead Republicans 40 to 35 on handling the economy, a complete reversal from where things stood after the 2024 election. And historically, the party in power loses House seats midterm. It's happened in nearly every midterm since FDR. It's one of the most reliable patterns in American political history. So we have a Republican Party holding the House by 3 seats, facing a public that already thinks the economy is headed in the wrong direction, with economic approval cratering, heading into an election in November. Now, layer on top of that, mass AI driven unemployment hitting the exact demographic that decides elections. James Carville, Clinton's famous strategist, put it perfectly in 1992. It's the economy, stupid. That maxim has defined American politics for 30 years. Economy goes bad, party in power loses. Full stop. Now, as a side note, I don't think the Democrats are going to win simply because they've displayed such a massive belly flop to the world on every forefront that I just can't imagine anyone with a sound mind, unless they're completely disconnected from the news, in which case I don't know how they're voting anyway. I just cannot see a scenario where they vote for the Democrats because there's no one intelligent on that side right now. Regardless, it's a risk, and the Republicans and Trump's administration has to win because there is no Republican House member who gets to keep their seat if their constituents are losing middle class jobs to AI. And the official response is the market will sort it out. We know that's not a survivable political position with November approaching. So I believe Trump's administration is going to pull it together, and they're going to give a stronger statement, and they're going to rally. That's my position. But even if in some crazy hypothetical world, the Democrats win somehow, they would win, okay? Because they would propose some emergency legislation, which the Trump administration can do too. The Republican team can do as well. They can propose an AI transition fund, expanded unemployment, job retraining programs. The point is, suddenly we would have both parties, for completely different reasons, arriving at the same conclusion. We need to send money to the people ASAP. And that money, right, has to come from somewhere. And in America in 2026, with a $36 trillion national debt, a slowing economy, and a Fed that's already been cutting rates, well, it comes from the printer. They call it a stimulus. They'll call it a relief. They'll call it an AI transition assistance program. The name doesn't matter. The effect is the same. Every dollar printed is a dilution of every existing dollar. And remember, Bitcoin has 21 million coins ever that will be created. That number can't change. So let me put the whole picture together for you now. AI displaces white-collar workers at scale. That in turn creates consumer credit stress, missed payments, rising delinquencies. Regional banks, which are more exposed to consumer lending and have thinner capital buffers, start to wobble. Their stocks start breaking down. Depositors get nervous, and the SVB playbook activates, but broader this time. Meanwhile, it's an election year. The jobs being lost belong to the exact middle-class swing voters that determine which party controls Congress. Political pressure to act becomes overwhelming. Both parties propose stimulus. Congress passes something. The Fed gets political cover for aggressive easing, more rate cuts, balance sheet expansion, whatever the moment requires, which makes the dollar weaken. At which point, liquidity floods back into the global financial system. Risk assets recover, and Bitcoin, which already bottomed in anticipation of this whole sequence because it's the smoke detector, not the fire, leads the recovery the way it always has when the printer turns on. That's 3 separate forces, all pointing in the same direction. The AI credit crisis, the political inevitability of stimulus, and the Fed's monetary response. Any one of them alone would be a catalyst. That's why I think 2026 is the year Bitcoin makes its move. Not despite the macro chaos, but because of it. But here's where I want to be very honest with you, because your trust matters more to me than making a confident prediction. There are real risks to this thesis. The 20% displacement number Hayes uses is aggressive. Most economists believe AI is currently eliminating tasks within jobs faster than it's eliminating entire jobs outright. Full-scale mass unemployment might be 2 to 5 years out, not imminent, though I do think it is much sooner than that. which means the banking stress might arrive more slowly in some reality, much slower than Hayes models out, though I do agree with him, but I have to show you the other side of the coin. And Bitcoin could fall further before this resolves. Hayes himself said it could break below $60,000 before the Fed acts. That's still a real possibility. And there's a timing risk. Political gridlock could delay the fiscal response longer than markets expect. The big beautiful bill that just passed already adds 2.4 trillion to the national debt. There are deficit hawks in both parties who will resist new spending, at least initially. So rather than claiming I know the bottom, let me tell you the specific signals I'm watching. The things that would confirm this thesis is actually playing out. First, we have consumer credit delinquencies. Credit card and auto loan 90-day delinquency rates. If those numbers start climbing in Q1 and Q2 data, Hayes' banking stress scenario is showing up in the real economy. And then there's regional bank stocks, not JP Morgan. Watch the KBW Regional Banking Index. If small and mid-sized bank stocks break down while the S&P 500 holds up, that's the divergence Hayes predicted. And then there's political response velocity. Midterm primaries start in March. So if you hear both parties proposing emergency economic legislation, AI relief, expanded unemployment, however they phrase it, job transition funds, that's the fiscal stimulus signal, which I will cover here at my channel. If Fed language shifts, if there's any hint of quantitative easing, balance sheet expansion, or emergency rate language, that's the liquidity signal Bitcoin has historically front run. And most importantly, Bitcoin's own behavior. If we see it stabilize and form a base, even while macro headlines are still negative, that is historically the setup before the recovery. The smoke detector goes quiet before the fire is out, but it goes quiet before it arrives too. So here's my thesis as we wrap up, and I want you to hold me to it. AI, I believe, is creating real economic displacement right now. Not in 5 years, in this month's job data. That displacement threatens the consumer credit system, which threatens regional bank balance sheets, which, according to Arthur Hayes, supported by the Bitcoin gold divergence we're watching in real time, is exactly what Bitcoin has been pricing in since October. But the layer I'm adding, we are 9 months from a midterm election. Republicans hold the House by 3 seats. The economy is the #1 voter concern. And the demographic most exposed to AI displacement is the exact swing voter that decides American elections. No political party facing those numbers can allow mass unemployment to arrive without responding. They will spend. They will print. They have always printed, and they have the power to do it. So why wouldn't they do it? They will, because they too will be affected by these jobs displacements and the social unrest I believe that would cause. And when they do, when that liquidity floods back into the global system, the same asset that bottomed first will recover first, because Bitcoin was built for exactly this scenario. So I don't know if the bottom is at $67,000 or $60,000. Nobody does. What I do know is that the system, the macro system, the political system, the monetary system is set up in a way that makes this outcome not just possible, but structurally inevitable. And Bitcoin, with its 21 million coin hard cap, was quite literally designed for this moment. But as always, none of this is financial advice. I'm a systems translator. I'm here to help you understand what's actually going on so you can make your own informed decisions. But if this video helped you think more clearly, understand all the moving pieces a bit more and how they connect, I would ask you like the video. It's a small favor you can do, and it keeps me highly encouraged. Every single like, every single subscription motivates me so much. And then what means even more to me is if you share my video with somebody that wants to know what's going on, somebody who's new, someone who's interested in Bitcoin but has questions, sharing my video with them would mean the world to me, because my mission and my passion is to help people transform their finances by learning more about crypto and Bitcoin and how it works, because I know it can be so daunting and overwhelming. Even if you already know about crypto, there's just so much to keep up with, and and politics and regulatory policy, it all connects and affects each other. So that's my goal here, is to connect all the dots for you, and then that way you can make your own decisions. But that's it for today's video. I love you guys so much. And I'm actually thinking of going off script and just covering the news in more conversational style with you. So if that sounds good to you, let me know in the comment section below, and I will give it a try this week to see how you guys resonate with it. All right, guys, I'll catch you guys here tomorrow. Take care.